Welcome back to our channel. Let's go back to the late 1990s and early 2000s, the dark period of financial markets when the dot-com bubble burst. During this time, many investors were eager to invest in internet companies, which were viewed as the economic future. As the bubble grew, however, many of these companies became overvalued and lacked a clear path to profitability. Despite this, many investors held on to their internet stocks due to loss aversion. Because of the bias, they felt more pain at the prospect of selling losing investments than pleasure at the prospect of selling winning investments. As a result, when the internet bubble burst in 2000, many investors suffered large losses as the value of their internet stocks plummeted. This loss aversion was reflected in many investors' behavior who continued to hold on to their losing investments, even as it became increasingly clear that the dot-com bubble was unsustainable. Hi, I'm Emma, your guide to the world of behavioral economics. Let's dive deeper into loss aversion to narrow our behavior gaps. Loss aversion is a cognitive bias that refers to the tendency of humans to strongly prefer avoiding losses to acquiring gains. In other words, people tend to feel the pain of losing something much more intensely than the pleasure of gaining something of equal value. This can lead to irrational behavior in decision-making, as people may take unnecessary risks to avoid losses or cling to losing positions for too long. As a cognitive bias, loss aversion can make individuals to behave irrationally and make bad decisions, such as holding onto a losing investment. It reflects a general bias in human psychology that makes people resistant to change. It can be explained by the endowment effect, which is the tendency to value something more highly simply because you own it. Loss aversion was first described in the early 1980s by psychologists Daniel Kahneman and Amos Tversky as a key component of prospect theory. The theory sought to explain how people make decisions under conditions of uncertainty. According to prospect theory, people tend to evaluate potential losses and gains in relation to a reference point, such as their current situation or a particular goal they have in mind. Losses from this reference point are felt more acutely than gains, leading people to be more risk-averse when it comes to potential losses. Loss aversion is a behavioral economics concept that has significant implications for how we make decisions, particularly in the areas of finance and investing. Loss aversion is a cognitive bias in which people feel the pain of losses more acutely than the pleasure of gains. This can lead to a variety of biases and errors in decision-making, particularly in the context of finance and investing. Loss aversion has important implications for a wide range of areas, including finance, economics, and public policy. In the field of finance, loss aversion can lead to investors taking on excessive risk in order to avoid losses, or holding on to losing investments for too long. It can also lead to a phenomenon known as the sunk cost fallacy, where people continue to invest in a project or investment even when it is clear that it will not be profitable. The reason is simply because they have already invested so much time and money into it. In the realm of public policy, loss aversion can be used to promote behavior change. For example, Policies that offer immediate incentives or penalties for certain behaviors may be more effective than those that offer delayed rewards or punishments. This is because people are more motivated to avoid losses than to pursue gains. There are several reasons why loss aversion occurs. One is that people tend to anchor their expectations to a certain reference point, such as their current status quo, or a previous experience. Any deviation from this reference point, especially if it represents a loss, can trigger a strong emotional response. Another reason is that people tend to overestimate the probability of negative outcomes and underestimate the probability of positive outcomes. This can lead to a tendency to avoid losses at all costs, even if it means passing up potential gains. There are many examples of loss aversion in action. One is the reluctance of investors to sell a losing stock, even if there is little chance of a recovery. This is known as the disposition effect. Similarly, people may be more likely to choose a lower risk, lower return investment over a higher risk, higher return option, even if the latter is a better financial decision. Another example is the phenomenon of sunk costs, in which people continue to invest time, money, or resources into a failing project or venture simply because they have already invested so much. This can lead to a vicious cycle of escalating losses and a reluctance to cut one's losses and move on. Loss aversion can lead to a variety of biases and errors, such as a reluctance to take risks or a tendency to hold on to losing investments for too long. This can ultimately result in suboptimal outcomes and a failure to achieve one's financial goals. Fortunately, there are ways to overcome loss aversion. One is to be aware of one's biases and emotions when making decisions, and to try to take a more rational, analytical approach. This might involve setting clear goals and strategies, diversifying one's portfolio, and avoiding the temptation to make impulsive, emotional decisions. Another strategy is to seek out advice and guidance from trusted experts, such as financial advisors or investment professionals. These individuals can provide an objective perspective and help to counteract the effects of loss aversion. In conclusion, loss aversion is a common bias that affects how we make decisions, particularly in the areas of finance and investing. By understanding the concept of loss aversion and taking steps to overcome it, we can make more rational, informed decisions that help us achieve our financial goals. Thank you for watching, and I hope you found this video was helpful. In the next video, we will explore hindsight bias. So, stay tuned.